Okay, let's see. A lot of questions here. A lot of them are overlapping, though. What if someone's getting a bunch of loans? Do you have discounts or paperwork reduction for an investor who may be cash out refining multiple properties? In other words, does it make sense of like, hey, I've got five, I want to do them all at once. I know I probably
Hmm.
can't combine them together into one big loan, but if
Right.
I'm just going to do five separate loans, is there any advantage to me doing them all five right now with you?
Oh yeah, I think that's a fantastic question, and it's something that we do, pretty regularly for folks. We get some economies of scale with paperwork, with underwriting, and with our processing team. All right, so Maggie and I, as an individual kind of team loan officer, have our own dedicated underwriting processing teams. Okay, so when we get a borrower pushing four purchases or four refis or more at the same time simultaneously with us, the big advantage that we have is really we're going to reduce our fees because of that economies of scale with our underwriting and processing teams and pushing the same paperwork through on each individual application. Because you're right, it is an individual application per property. You cannot cross collateralize under one loan like a commercial guy can. However, the advantage there for the individual borrower is twofold really. It's A reduction in fees from the lender, and B, we're licensed in all 50 states. So if you've got your portfolio across the country, you don't need to go to different lenders and have your credit inquiry done by multiple lenders in multiple states. So there's a huge advantage for having a lender like us who will not only execute the processing and underwriting of your multi-packed loans scenario, but also, it's a one-time hit to credit, and it's a significant reduction in fees. So,
HELOCs, do you do home equity lines of credit?
we do offer home equity lines of credit. We're not a bank, we're a correspondent lender to the big banks. So we do have some home equity products, primarily for your primary home and your
Right.
second home. We do not have, unfortunately, at the moment, we do not have an investment property home equity line of credit product.
Mm-hmm.
We certainly were going down and pushing that angle quite aggressively over the last 12 months or so, but the retraction in the market has definitely pulled that product back with no kind of ETA on return at all. So
Right.
something we have in mind. We certainly have it in mind. We're trying to develop it, but with the current situation, it's frozen for sure.
Here's a good question. This thank you for that. And this comes up a lot. Do non-QM or non-recourse loans, do they count towards your Fannie Mae TED and limit?
Typically, no. I mean, your non-recourse self-directed IRA loan would not be counted necessarily against your limit because
Right.
it's financed to your LLC. It's not financed to you individually. You're not the
Right.
note holder. Similarly, the way your ROI on that property or your profit on sale from that property doesn't go to you individually. It goes back into your IRA, the vehicle that financed the property to begin with. So as it relates to self-directed IRAs, no. As it relates to commercial properties, finance commercial properties, those do not get counted against the total count either.
Mm-hmm.
But you really want to have those documented on your commercial, your LLC tax return, your business tax returns as well, just to show that they are commercially financed, in addition to maybe the commercial note. So some underwriters will ask for, some due diligence there on that, but for the most part, non-recourse or commercial notes are not counted against your 10.
Got it. All righty. Do you have a seasoning requirement for refinance? Usually
It's
6 months, isn't it?
right. If you want to take cash out of the investment property, if you want to do cash out, there's typically Fannie and Freddie want you to be on title for 6 months before taking any equity out of the home. And it kind of goes back to, let's say you got a really good deal on the house. You bought it for 50, but it's worth 100, and you want to take the 75 out right away. You really need to show that you've been the owner of the property for a little bit of time, which is 6 months, to do that. So using that higher appraised value from Fannie Mae and Freddie Mac guidelines, at least, is such that you would need to be on title for 6 months to use the higher value. Now, if you're just buying the house in cash and you got a really good deal on it, and you just want to finance it, we can do what's called delayed financing, or sometimes it's called a technical refinance. But delayed financing is simply that. You're just delaying putting the financing on the property that you bought in cash, and you're getting 75% of that purchase price back immediately. You can apply for that loan as soon as you buy the house in cash, and we could close on that loan maybe 30 days later, but we are limited to the appraised value being at least the purchase price. So if it comes in higher, we're going to be limited to the purchase price, and that's only within those first 6 months.
Right. So just chill out, wait till after 6 months, and then you get to utilize the hopefully higher appraised value, get 75% of that higher value. You just have to be patient, wait 6 months.
Right, and if you're buying it in cash and maybe doing the financing, the renovations yourself or whatnot, it may take a little bit of time for you to get another appraiser in there and get the higher value anyway. But we would take that application at day 150 and fund on day 181 or day 182. So it's exactly 180 days from the acquisition date. So we would time it such that we would do all the heavy lifting, and do the application maybe at day 150, and then 30 days later, 35 days later, fund the loan with the higher value. So it is a seasoning requirement, but as you said, it's a little bit of patience can reap some reward there with the higher value for sure.
Yeah, absolutely. Okay, got a question from Michael about looking at refinancing some properties in the 60 to 120 balance range. And can you give an idea as to what the average closing costs are? I mean, in other words, is it 3,000? Is it 5,000? Or is it a percentage? What are the costs of doing one of these?
Generally speaking, it's not a percentage of the loan amount for us, at least. We have a flat lender fee for processing, for underwriting, for the tax service fee, and the flood certificate. Right, we do a flood certificate on every house, regardless of whether it's in a floodplain or not, just to determine if it is in a floodplain. Because if it is, it requires flood insurance. But we have a flat fee for all of that of $1,295. And again, we work on that fee with you if you're doing multiple deals simultaneously, because that's the fee that we can control. Okay. In addition to that, you have your appraisal fee, and it varies from market to market, but a single family home appraisal fee would probably be around $450, maybe $500. Your multi-unit is a little bit more expensive because of the multi-units and the appraiser looking at multiple units. So that's probably around $650 to $700. And then your title and recording fees can also vary from market to market. Florida is probably a little bit more expensive, let's say, than Tennessee for title and recording fees. But on average, I would say in most of the turnkey markets that we're active in around the country, you're going to see title and recording fees hover between $1,400 and $1,600. Okay?
Right.
So if you add them all up, and you're up to like $3,300, $3,400, depending on where the property is located, and that's in addition to your down payment, right? So. Right.
Yep.
One thing you could do there is try and negotiate a slightly higher price and get the seller to give you a seller credit for closing costs. So if you're buying a place for $100,000, maybe renegotiate the price to $102 and get $2,000 back, get that 2% back, and that can be applied towards the closing costs to reduce some of the fees, the transaction fees. And basically, there's a very small difference in your payment when you're putting 20% down on 100 versus 102. So the cash in your pocket goes a long way there in terms of the small difference in payment for a slightly higher loan amount based on a 2% addition to the price. And as long as the value comes in at 102, that's allowed all day long. Fannie and Freddie will allow the seller to give you 2% back.
Right. Okay. No, that's a good idea, actually. It really has. Really is. Okay, so let's see. Have debt to income rules changed over the last couple of months? I always remember it being like about 43 or so. What is debt to income? What is the ratio, the magic number that you're looking for?
Well, I mean, sometimes it depends on the borrower characteristics, the strength of the borrower. But in general, your back-end ratio, your back-end debt to income ratio is 43% of your gross monthly income. Now that back-end ratio that I'm talking about is everything. It's your current housing payment, taxes, insurance, maybe a car payment, student loan debt, credit card obligations each month. That as long as all of that adds up to less than 43% of your gross monthly income, that's a typical guideline for debt to income ratio. Now, your front-end ratio is the ratio on the housing payment for the subject property. minus any of that other obligation. So you've got a front and back end ratio, but it's the back end ratio that really drives the qualifier. In recent times, we've been able to get the debt to income ratio up to as high as 50% of your gross monthly income. So if you're adding properties and growing your portfolio, you could certainly expand a little bit beyond that 43% general guideline. But again, that really depends on strength of borrower. So assets are a big part of it there. Credit score is a big part of it there. And the down payment can certainly be a help if you're putting 20 versus 25% down and kind of looking for that expanded debt to income ratio. I will say that ratios, Fannie and Freddie will allow us to use the subject property rental income to offset the projected obligation on that house. So even if that new property that is not tenant occupied, we can get a comparable rent schedule from the appraiser. Now it costs you another $100 or so, $150 or so to get that comparable market rent schedule. And we can use 75% of that to offset the new projected debt that you're going to incur on buying that new investment property. And that basically washes it out. Similarly, if you just purchase an investment property and it became tenant occupied, we can provide the underwriter with a lease. And as long as 75% of that lease exceeds the obligation on that property, your debt to income ratio really won't move. Now, Fannie and Freddie have new guidelines as it relates to that in relation to Freddie will only allow you basically to wash out the obligation. They're not going to add to your base income because your rental income at 75% is higher than what your principal and interest and tax and insurance obligation is. So Fannie Mae is a little less stringent on that at the moment. If you have a landlord history and you own your primary residence, you can still add to your base income a little bit. But generally speaking, it's a wash. We're just going to use the rental income to offset the new obligation and move on, and your debt to income ratios won't move. So as you add properties, as long as you've got the liquidity for the down payment and the closing costs, your debt to income ratios may not be affected whatsoever by adding more and more homes or refinancing or financing multiple properties at the same time. So that's a big advantage for us as a direct lender to Fannie and Freddie, because certain banks may have restrictions on that. They may say, oh, you need to be a landlord for 2 years before you can use that. So other banks and lenders will always have what we call credit overlays that they can apply based on their perception of risk for an individual borrower.
Right.
So Fannie and Freddie at the moment, we follow their guidelines. We don't put any credit overlays on top of them. And we try to finance as many deals as we can directly to Fannie and Freddie so that we stay competitive in the marketplace.
Gotcha. Okay, so here's a nice technical question, kind of tax related. Good afternoon. Have you ever dealt with using a person's IRA in connection with determining qualifying income? I understand that you can use a formula to treat a portion of the value of their IRA as qualifying income.
So as it relates to, so that's basically asset-based income qualifiers, and that product typically is used for your primary home residences, your second home residences. So a borrower with significant assets in their IRA, but not necessarily an income. Maybe the person's retired or maybe just temporarily out of the workforce, but has significant assets. You can certainly determine an income based on that asset and the expectation that the balance in that asset will continue for 3 years based on the calculation of the rent, the income that you can generate from that. Generally speaking, we do not apply asset-based qualifying income for investment property financing. So that's the kind of the kicker there as it relates to investment property financing.
Right.
Certainly, there's asset-based financing. For self-employed borrowers, there's even bank statement, what we call bank statement financing, where you can see the revenue coming into the business as the income, as opposed to calculating the net income after the accountant has filed the tax returns. So there are those products, and those are generally speaking non-QM portfolio loan products. But to use your asset,
but they're only for primary residents. Yeah.
Yeah, you may find a lender out there, a non-QM lender who would accept it, right? I'm not saying that they're not there. It's just not something that we would offer on an investment property finance deal.
Yeah, because I mean that happens. It's frustrating to a lot of people. They're like, hey, look, I don't know, doesn't matter how old they are, but 62 years old. I've got $2 million in the bank. I've got this 810 credit score, but my income is kind of Social Security, and that's about it. I mean, I'm fine. Yeah. I'm in great shape, but yet the banks won't touch them because they've got $3 million and an 800 FICO score, but they on paper they're only making, $19,000 a year.
Oh yeah, and there's some lenders that will amortize that asset over 30 years, right? So they'll take 70% of the asset or 60% of the asset and amortize it over 360 months to generate that monthly income. There's other lenders that will do it over 5 years, and all of a sudden you've got much more income potentially that you can take from that asset or generate. You don't necessarily have to take it out. You just have to, you can qualify with that income. So each one of those individual lenders will have certain guidelines or specific credit risk tolerances for that type of lending. It's not very often that we see it on acceptable for investment properties, however. I'm not saying they're not there, but we just don't offer that.
Okay. So in other words, if I've got somebody who's a retiree that fits that scenario I just laid out, it doesn't really help for them to call you, because if they're looking to buy an investment property, you don't have anybody that you can steer them to.
Specifically as it relates to Acidbased, but as it relates to your non-qualified debt service coverage ratio loan that I mentioned, the one that's coming back out of suspension, that's something that we can certainly apply to that kind of borrower. Right? Okay. So we don't necessarily need to use the asset-based income. We can use the rental income being generated by the subject property to qualify that borrower. Now, again, albeit at a slightly higher rate and maybe a little bit more expensive than you would normally see from a Fannie Freddie loan if you were employed and had your qualifying basic income. But as it relates to that borrower who doesn't have the asset-based option to buy an investment property, I would flip it into the other product and use my debt service coverage ratio product.
Okay. Well, the bottom line is, I mean, this is all fairly general. They should give you a call and find out. I mean, Thomas writes in, what if that retiree starts taking monthly distributions? Well, those monthly distributions, that's income, right?
That's totally fine. I mean, that's totally different. That's you're taking that, you've established that distribution, you've established where it's coming from, you've established the size of the asset, and we can determine that based on the income distribution that you are taking, that can continue for at least 3 years. So if indeed you are at that stage where you just want to take that formal distribution from the asset, absolutely, you can do that, and Fannie Mae and Freddie Mac will accept that all day long,
right?
Because there is the expected continuance of that particular monthly amount coming out, and the balance in the account showing that can continue for the next 36 months. So that's absolutely, we do that quite frequently with folks, but it's a formalized distribution from the asset as opposed to just, hey, I could take this out and I could qualify if I did it.
Gotcha. Okay. All right. Well, we're going to wrap this thing up. I've got one more question here. Some of these are so technical that I don't think we want to go down that rabbit hole here. But there's one. Do you see, two more questions? I take it back. All right. Do you see that mobile notaries are going to become virtual notaries more often? With this environment, do you see things loosening up a little bit to where you can use a virtual notary and not have to have someone come to your house or go somewhere?
Oh yeah, I mean, to a degree it exists right today. You can do, what we're doing primarily is hybrid closings. Where a lot of the closing package is emailed to the client to DocuSign. Right. There are certain documents still in that package that need to be wet signed, or we need a wet signature on that has to be notarized. So a mobile notary would come, separate the package out, highlight the ones that need to be wet signed, and then drop it in the current environment, maybe drop it in the mailbox and drop it on the doorstep, sit in their vehicle, wait for you to sign those documents. It happens very quickly because the rest of the package is signed via DocuSign quickly. And then you just text a copy of your photo ID to the notary. But as it relates to the full-blown e-signing, a lot of the pushback, I suppose, not pushback, but a lot of the reason why we can't do it widespread at the moment is because it's basically, it comes down to the county level. You know, so the mortgages are recorded on the county level in the state that they're in or the market that they're in. And some of those counties just don't have the capability for the full e-signature just yet. So as it goes forward, absolutely, I think it's going to become a thing of the future. And I think hopefully for everybody from an ease of a closing perspective, I would hope that comes sooner rather than later, nationally across the country, across every county. But at the moment, there are just certain counties that are not capable of taking that and recording that e-signature as simple as it might sound.
Got it. Okay. So Joe, why don't you advance to the next slide so that we can have, instead of this word questions, we can at least have your information up there.
Yes.
And
thank you. Yeah.
And I'm gonna ask the final question while this is up there, which is how are appraisals being done with COVID in many locations in shelter-in-place environments? I mean, you still, if someone's living in the property and an investor is buying it, how are the appraisals being done?
Yeah, it's a fantastic question for the times that we're in, obviously. But most loans that we do with Fannie and Freddie, we're just doing what we call an exterior-only appraisal. So essentially, the appraiser will accept the order and do a drive-by, maybe stop and take some photos, exterior photos of the house or the property. Certainly, they're always going to do a street view and things of that nature. Exterior, when on a typical full interior-exterior, you're going to have both. But in this case, in the environment that we're in, we're basically just doing an exterior-only appraisal. Now, people will ask, why does it cost as much, or why is it just a little bit less than your full interior-exterior? We generally see about a $50 decrease in the cost of the appraisal because it's exterior only.
Right.
Because they're still pulling the comps, they're still writing the report, and they're still driving to the property. So it's not like they're just pulling the data.
All right. So if you have any questions, Joe or Maggie, JM Lens at myccmortgage.com. Or you can just visit the Learning Center on our site. And we've got our lenders, of which Joe and Maggie are one of them, right there under left side under lenders. There they are. They're smiling faces, email, phone. It's all right there. Or if you just want to contact your IC, investment counselor, there's 4 of us. I'm one of them. And there's also Leah, Joe, or Aristotle. You can also talk to us about anything, frankly, the lenders or the various markets. And I think there's another slide after this. Joe, go ahead and advance. Yes, there is.
Yes.
I was getting nervous. I think there is. Anyway, Good job, Joe.
Well, thank you very much.
much.
Thank you very much for having us. I know Maggie has regrets she couldn't make the call, but maybe for the next time you'll be able to introduce everybody to her on the next webinar. And I really appreciate everybody's time this afternoon. Please don't hesitate to give us a call. We can go through any of those questions in more detail.
All right. Okay. Thank you very much. And for all those still listening, thanks for all writing in all the questions. We appreciate it. That really helps. And tomorrow, 24 hours, well, 23 hours from now, we'll have Tampa on, our Tampa property team, talking about what's new in their market, what they're doing, and they've got some new things they're going to roll out. So tune in tomorrow. Thanks, everybody. We'll do it again, 24 hours. Have a good one. Thanks for tuning in.
Thank you.